Hey everybody, it's Chris. In this video, I will discuss financial statements at the fund level for investors. I have not found any coverage of this topic specifically. Understanding and analyzing the financial statements of the funds themselves is an important component of financial due diligence for investors, right? So I'll be eager to hear your feedback on this. Some of you may understand a lot of this in the video already. Others may leave with more questions than answers. So I'm happy to do a webinar after and discuss any comments and do Q&A. So let's get right into it. This slide really on a conceptual level, tries to discuss the financial statement process and really want to think about this going from left to right and the process of generating and even analyzing the financial statements. So I'm not going to go into specifics in this video on how we construct the financial statements themselves, but I want to show you at least what they represent and how they interact with one another for purposes of analyzing your deals, your funds. So first, starting with the income statement, this represents the flow and activity of the fund throughout a given period, for example, a year in this case. And it's a flow statement, right? It covers a period of time. And what we get from this is the net income for the whole period. And with that, from the income statement, we can generate what the changes in capital are for the fund. And this tends to be called statement of changes in partners' capital or in members' equity or members' interest. That just differs based on the type of entity. And this is also a flow statement. It covers the changes in capital over the period of time. And after that, with those two generated, we can build the balance sheet. In fund parlance, that's called the statement of assets, liabilities, and partners' capital, or members' equity. This is different in the respect that it's not a flow statement. So this is just a snapshot in time at the end of the period, at the end of the year, end of the quarter, whatever period is being covered. And then last, certainly not least, but we build the cash flow statement, which pulls from all three of the previous statements. And this tends to be the most difficult to understand for investors, but it's really one of the most important ones because as investors, we ultimately rely on the cash flows to value the deals, the investments, and hopefully benefit from the investments. Then after that, we'll discuss a little how these statements connect and interact with one another so you have a better foundation for conducting your own due diligence. So first, here's our income statement. And this is a fictitious company. They're made up numbers. However, all the statements in the video balance and in the Excel file I'll provide, and they all connect with each other properly. The financials throughout the video are meant to reflect specifically aspects of what we invest in as accredited investors, particularly private credit, real estate equity, things like that. Now remember, the income statement reflects all the activity during the period. So in this case, it's a year ending December 2023. And we need this statement first to know what to roll in to the year-end balances and the other statements. So starting at the top, as you can see, interest income have $5 million. So in an investment fund, for our purposes, this typically refers to income from loans, real estate loans, or it could be private credit that's extended to portfolio companies. An important part to realize is this line item also includes non-cash interest, or just interest that hasn't been paid yet, right? So, and this can include paid-in-kind interest, PIK, that's a common one for private credit funds, and that will actually sometimes be broken down in its own line item below interest income. But in this case, when it's rolled up, we consider it's included in interest income itself. And next, rental income, pretty self-explanatory. You'll typically see this for a real estate private equity fund for the rental income on the properties. Overall, with the total revenue, it's important to remember The income may not always be received in cash again, and we use the cash flow statement later to assess that. And it helps us understand how healthy the cash conversion is of the fund. In the expenses section below, first the property expenses. Those are pretty self-explanatory again. This includes operating expenses for a real estate property, right? You're not going to see these in private credit funds. Items like repair and maintenance, property insurance, utilities for the property, etc. And next, interest expense. And also these, sometimes you'll see these line items in a certain section are sorted by greatest to lowest by amounts. So you may see the order change. This is not a particularly specific, a required order that these line items need to be in. But interest expense is next on this statement for $1 million. That reflects any interest that's accrued by the fund, not necessarily paid, but it's accrued on debt owed by the fund. Then we have management fees. These typically will reflect asset management fees, not portfolio or not property management fees, because those are included in property expense a couple lines up, right? Those are a property specific item. So you'll see management fees on all the different types of obviously private investment funds. And the next two are, I think, pretty self-explanatory, not really worth going over. Professional fees and admin, those are, right, your accounting, taxes, compliance type of costs. The next one to touch on is probably performance fees. These are typically from hedge funds. They're deducted as an expense on the income statement. This is different than carried interest. Carry is, you'll see on the next slide, that's actually a reallocation of equity, so that doesn't show up on this statement. But I'll show you in the next screen. And then subtracting the expenses from the revenues, we have a net investment income of $809,000. This is similar to the operating income for a company, right? Maybe a public stock you'd look at. This is before any one-time items or any gains or losses. This is not really equivalent to the net operating income for a property fund, right? You have some of these items up here: management, administration, etc. Interest expense are not really they're gonna be below the line of NOI. So I just, the wording is a little similar. So just want you to understand this is not necessarily net operating income for a real estate equity fund. Okay. So with the net investment income, this is more of our operating activities, right? And below that we have net realized and change in unrealized gains and losses. These are actually non-cash items, right? And they're non-cash. They're adjusted out on the cash flow statement. They're non-cash because the cash is actually accounted for on the balance sheet in separate journal entries. So I'll actually show you that in the cash flow statement. Don't need to worry about that right now. But an important point to understand is the unrealized portion. The second line here for $14,000 is actually where we see the result of sponsors marking up or down their NAV, right? This is important, especially with things we covered in the newsletter like non-traded REITs, non-traded BDCs, where there isn't much price discovery, but sponsors sort of have the liberty to mark their assets up and down. And then we take the net investment income, 809, add the 14, and that gives us our net income for the period. And this will be carried to the changes in capital on the next slide, and also the cash flow statement later on. Another thing to note here with the asterisks, net income is the common terminology for financial statements, but in fund financials, often you'll see this term net increase or decrease in partners' capital or members' capital from operations. It's the same thing. This is just parlance for fund accounting. So next, Let's move on to changes in capital. I use that term just because it's a little easier and quicker to say than the statement of changes in partners' capital, but this is all pretty much the same. You'll recognize the $823,000 in net income, so we need that income statement, the net income there to fill this in here at the bottom and fill out our the statement in partners capital changes. The blue numbers above are pretty much hard-coded. They're provided by the fund, right? There are no formulas to calculate for those. The black numbers you'll see throughout all of the slides and the Excel file are calculated cells. They are formulas. And the statement reflects changes in partner capital in aggregate, right? This is taking into account all of the individual partners as a whole. So these aren't individual partner statements at all. And first, we start with the beginning year figures. We have partners capital at the end of 22. And total capital column on the far right is just a sum of the first two, the GP and LP columns. And starting with partners capital, we have in the beginning the first two together. We have contributions first of 2.2 million, right? This is investor contributions into the fund during the period. The next two lines after that, the negative 1.8 and the positive 900,000, together represent your net investor distributions. That net meaning, it removes the drip, right? The dividend reinvestments. So, for example, the fund had 1.8 million of distributions to investors. It actually only remitted half of that because the other half, 900,000, was actually reinvested back into the fund. So together, you'll see later, these are net distributions. Next, the redemptions and withdrawals, and these are pretty much the same for our purposes, just a little bit different terminology can be used. But these are obviously your requests for redemptions, right? Different than distributions. The next column, the next row, is the carried interest, and this is what we talked about in respect in the income statement when we talked about performance fees, so which are not carried interest. The carried interest is actually taken out here on the statement of partners capital, and it's pretty much a non-event for the total capital of the fund, right? It's zero until the GP actually will withdraw its own capital, redeem its own capital. But during the period, you have $42,000 in carried interest, and this is just a reallocation of equity, of capital, right? From the limited partners negative to the general partner positive. So this is not an expense of the fund. This is just a reallocation of ownership. And next, we add the net income, and we get the ending partners capital for each of the partners and in total. And this again is a flow statement, right? So this reflects the capital activity throughout the entire period. This will carry to the balance sheet, the beginning and ending partners capital. Next, we have our balance sheet, and in fund parlance, that's the statement of assets, liabilities, and partners capital, or members capital, depending on the entity type. And this statement is a snapshot in time, right, at the end of the period. In this case, it's December 31st, 2023. You can think of the figures on these statements changing each day throughout the year, right? So you have almost a series of 365 different days of these statements throughout the year, but we only need the last one, December 31st. The prior year column for 2022, I add it here as we need it later on to build the cash flow statement and understand that. But when you review the fund financial statements in real life, so to speak, you're not going to see this. So this will only show the current year, and you'll need to reference the prior year separately on another, another PDF, another statement. You'll notice that most of the figures are hard-coded in blue. They're provided by the sponsor and shown on the financial statements that are issued. The capital accounts in black are pulled from the last slide, the statement of changes in partners' capital that we discussed. And you'll see how that all flows together later. Just to be sure everyone understands the overview here, I know a lot of people probably understand this, but the balance sheet, obviously you have your assets, and total assets, 92 million. These need to equal the sum of your liabilities and your partner's capital, right? So we have 92.5 million of assets, and the liabilities and the partner's capital together equal 92.5 million as well. So both sides need to equal. A way to think about this is the assets section is everything the fund owns. The liabilities are the claims on those assets, and the partner's capital is the equity remaining, right? It's kind of like the plug figure, what's left over for the partners and owners. Investments, starting on the top now, we'll just kind of go through line by line, and you can follow along here on the right side as well. Investments obviously comprise usually the lion's share of the fund assets. For a private credit fund or a lending fund, this primarily will be loans. Notice the investment is recorded at fair value of $90 million. And the cost is shown in the parentheses, which you'll usually see it displayed that way in the financials. The cost and the fair value are reconciled on another part of the financial statements called a schedule of investments, which we won't cover in this module. But for a private equity or private credit fund investments, this will consist of the portfolio companies. So we're kind of moving on. Another example of the investments at fair value for private credit, private equity, those are going to be the portfolio company investments. Real estate, private equity fund, that will obviously be your fund properties, right? Your apartment complexes, industrial buildings, whatever it may be. And in this case, sometimes this statement records this under a different section. So you may see current assets, and then your investments are in a lower section called non-current assets. Just because they typically denotes an expectation that they're less liquid. Usually current assets have an expectation of liquidity within 12 months. I see it both ways, just something to be aware of. It doesn't necessarily mean anything. You may see private credit funds have more classification as current assets because they tend to be short loans, right? Maybe a year or less or a few years or less. So it just depends. Next, we have cash in the bank. Pretty obvious. Interest receivable. This is the interest that's due from borrowers. All right, this would be more so for a lending fund or private credit fund. So this is due from borrowers, but not yet received. Right? They're not necessarily past due, but they're just recorded already. And a couple lines down, you have restricted cash, which is also a part of the cash classification for the cash flow statement. And those are things like escrow for lender may require escrow for a mortgage loan, things like that. Reserves required by the lender. So you'll see those under restricted cash or some similar name. The prepaid expenses are pretty easy, I think. Those are expenses like insurance that you may pay for up front, say in November before the end of the year, but it's just not used or expensed yet. Maybe it's premiums for the following year. And that's pretty much the asset section. Next, we'll move on to liabilities. And starting with the first line, we have credit facilities and notes payable. This is your debt. Obviously, credit facilities. Sometimes it may say mortgage loan payable. There's a bunch of different names for these. Often, this type of line item is the largest liability, especially if you have a fund that employs leverage, even if it's just for cash management purposes or subscription lines. But it comes under many names. Sometimes it can be classified as non-current as well, just like the investments are, because they are just less liquid. They tend to have longer maturities. The next line is distributions payable. These are distributions that are not yet sent out to investors as of the end of the period, but they are recorded on the books. Just timing issues around the end of the year. These are usually fairly small, and I don't pay much attention to those. Same for the next line, contributions received in advance. These typically are capital calls that may be received right before the period ends, but the fund hasn't had that close yet. So think of a wire that you may send, they receive on December 27th in the fund, but it's for closing on the 1st of January. So the as of date for the balance sheet is the 31st. So there's just a timing issue there. Again, typically small amounts. The interest payable, again, should be pretty easy to figure out. That's interest accrued but not yet paid to the lender. Payable to GP is this comes under many different names as well, but this can include various things from asset management fees that are accrued, performance fees, they're accrued just not yet paid. Can have different names. You may have asset management fee payable, performance fee payable, etc. So just something to be aware of. And finally, accrued expenses and accounts payable are typically pretty small, and these are bills that have been recorded but not yet paid as of the end of the year. So those are your main items for assets and liabilities. You subtract the liabilities from your assets and you're going to get your partner's capital. Oops, sorry about that. And your, let's see here, partner's capital, like I said, it's taken from the prior statement and pulled into the balance sheet. And I think I will stop right there for a moment.